Imagine collecting thousands of dollars in rent every single month without ever unclogging a toilet, chasing a late payment, or dealing with an eviction notice. It sounds like a fantasy, but for smart investors who understand the public markets, this passive income stream is a reality, right now in late 2025. Most people assume that the only way to build massive wealth in real estate is to take out a mortgage, buy a rental property, and become a landlord. But the truth is that the landlord lifestyle is often a second job that burns you out, eats up your weekends, and exposes you to massive liability risks. There's a superior alternative that allows you to own premium real estate assets across the United States, while someone else handles all the headaches. I am talking about real estate investment trusts, or REITs, which are essentially companies that own and operate income-producing real estate. When you buy shares of a REIT, you become a partial owner of the underlying properties, legally entitled to a share of the profit they generate. By law, these companies must distribute at least 90% of their taxable income to shareholders in the form of dividends, making them incredible income vehicles. However, not all REITs are created equal, and many retail investors get burned by chasing the highest yields without understanding the underlying business models. Today, I am going to break down 5 specific REITs that give you exposure to billions of dollars in real estate without the tenant nightmare. The first pick is the absolute gold standard for passive income lovers, famously known as the Monthly Dividend Company, Realty Income Corporation, trading under the ticker symbol O. This company has virtually invented the strategy of reliable, monthly cash flow for conservative investors. Realty Income does not just own random apartments. They focus on freestanding commercial properties leased to high-quality clients like 7-Eleven, Walgreens, and Dollar General. The magic here lies in their specific business model, which uses what industry experts call triple net lease agreements. In a triple net lease, the tenant is responsible for paying the property taxes, the building insurance, and almost all maintenance costs. This means that when the roof leaks at a Realty Income property, the corporate tenant fixes it, not you and not the Realty Income management team. This structure protects the company's profit margins from inflation because rising maintenance costs are absorbed by the tenants, not the landlord. Realty Income has an incredible track record of declaring hundreds of consecutive monthly dividends, increasing that dividend over 100 times. Even in volatile markets like we saw earlier in the decade, their occupancy rates remained historically high because their tenants sell essential goods. The risk here is interest rates. Since REITs rely on debt to buy properties, high rates can squeeze their margins, but Realty Income has one of the strongest balance sheets in the game. If you want a foundational stock that acts like a paycheck replacement, Realty Income is often the first name on the list for a reason. You are essentially becoming a landlord to the biggest companies in America, collecting rent from their operations without lifting a finger. Moving on to the second pick, we are looking at a unique sector that combines real estate with entertainment, Vici Properties. Vici is an experiential REIT that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations. They own the real estate under iconic Las Vegas landmarks like Caesars Palace, MGM Grand, and the Venetian Resort. This is the ultimate real estate without tenants play, because their tenants are massive, publicly traded casino operators who cannot afford to lose their location. If a residential tenant loses their job, they might stop paying rent, but a casino operator generates revenue directly from a physical building. In fact, Vici famously maintained 100% rent collection even during the global lockdowns of 2020, proving the resilience of their mission-critical assets. Their leases are also incredibly long, often spanning decades, which provides a level of cash flow visibility that you simply cannot get with residential rentals. Furthermore, roughly half of their rent roll has CPI-linked escalation clauses, meaning your income stream is explicitly protected against inflation. The barrier to entry for building a new casino on the Las Vegas Strip is astronomically high, giving Vici a massive competitive moat. While the gaming industry can be cyclical, the landlord sits in a privileged position, collecting rent regardless of who wins or loses at the tables. Recent years have seen Vici expand beyond Vegas, diversify into other experiential properties like bowling alleys and golf courses. If you want to own trophy assets that are impossible to replicate, Vici offers a high yield and a business model that is built to last. Our third pick takes us into the backbone of the modern economy, industrial real estate with Prologis, ticker symbol PLD. Prologis is a global leader in logistics real estate, owning nearly 1 billion square feet of warehousing space across the planet. Think about every package you order from Amazon, every sneaker you buy from Nike, and every part used by Ford. They all pass through warehouses. Prologis benefits directly from the secular growth of e-commerce, as online sales require roughly 3 times the logistics space of traditional retail. Unlike complex office buildings or hotels, industrial warehouses are essentially concrete boxes that are incredibly cheap to maintain and easy to lease. When a tenant leaves a warehouse, preparing it for the next tenant is quick and inexpensive compared to renovating an apartment or an office floor. Prologis has incredible pricing power because the supply of industrial land near major cities is shrinking while demand continues to rise. In recent years, we have seen their mark-to-market potential explode, meaning that as old leases expire, they can raise rent significantly to match current market rates. This embedded growth potential means that Prologis can grow its cash flow even without buying a single new building, simply by renewing leases. The risk for industrial REITs is a major global recession that slows down consumer spending and trade, which will reduce the demand for storage. However, supply chain resilience has become a national security issue, prompting companies to hold more inventory, which benefits Prologis. Owning PLD is like owning the toll roads of the global supply chain, taking a cut of global commerce without shipping a single box yourself. For the fourth pick, we are looking up at the sky to capitalize on the digital revolution with American Tower, ticker symbol AMT. American Tower is a specialized REIT that owns, operates, and develops wireless communications infrastructure, primarily cell towers. Their business model is beautiful in its simplicity. They build a vertical steel structure and lease space onto carriers like AT&T, Verizon, and T-Mobile. Multiple tenants can lease space on a single tower, and adding a second or third tenant costs American Tower almost nothing, causing profit margins to soar. The demand for mobile data is exploding with the rollout of 5G and the future transition to 6G, requiring denser networks and more equipment. Cell towers are strictly zoned and difficult to build, creating a natural monopoly in many areas where American Tower already operates. Tenants usually sign non-cancelable long-term leases with built-in rent escalators, ensuring steady growth for shareholders. Beyond towers, American Tower has aggressively expanded into data centers, creating a synergistic ecosystem for the digital age. This is real estate without tenants in the truest sense. You are leasing steel space to massive corporations, not living space to people. The biggest risk here is consolidation among telecom carriers, which will reduce the number of potential tenants, but the data trend is undeniable. With a dividend that has grown rapidly over the last decade, AMT is a growth-focused REIT for investors who want capital appreciation alongside income. It allows you to profit from the smartphone addiction of billions of people without having to pick the winning tech stock. Finally, our fifth pick is a recession-resistant king of storage, Public Storage, trading under the ticker symbol PSA. Public Storage is the largest owner of self-storage facilities in the world, recognizable by those iconic orange doors you see everywhere. The self-storage industry is driven by the 4Ds: death, divorce, downsizing, and dislocation, which happen in every economic environment. When the economy is bad, people downsize and need storage. When the economy is good, people buy more stuff and need storage. These facilities have incredibly low operating costs because they require very few staff members and minimal maintenance compared to other real estate. Public Storage has a fortress balance sheet, meaning they have very low debt level compared to their peers, protecting them from high interest rates. They have also been integrating technology, allowing customers to rent units and access properties via an app, further reducing labor costs. Unlike residential leases that are locked in for a year, self-storage leases are month-to-month, allowing PSA to raise rents quickly to fight inflation. While it is a competitive industry, Public Storage has the scale to undercut competitors on price while still maintaining healthy profit margins. Investing in PSA is a defensive play, adding a layer of safety to your portfolio that tends to hold up well when other sectors are crashing. It is the ultimate hands-off real estate investment, profiting from the American consumer's endless accumulation of personal belongings. So you have Realty Income for stability, Vici for experiential value, Prologis for logistics growth, American Tower for tech infrastructure, and Public Storage for defense. Building a portfolio with these 5 names gives you a diversified empire of real estate assets without a single tenant phone call. You could allocate 20% of your real estate capital to each of these to balance high yield, dividend growth, and capital preservation. Remember, while these companies remove the hassle of management, they still carry market risk. So always do your own due diligence before buying. If you want to see exactly how I would structure a $10,000 portfolio using these stocks, let me know in the comments below. Make sure to subscribe and hit the notification bell so you don't miss our next deep dive into high-yield dividend ETFs.